When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave, Chase, and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Welcome to the Retire Your Way podcast. I'm Ron Stutz along with Chase Lopez, and we're going to talk more today about IRAs. And if you'd like to get all the rules and regulations straight in your head, or better yet, if you just want to rely on Chase Lopez and Dave Lopez to do that for you, well, then I would suggest you call this number, 540-720-5656, 540-720-5656 for ILG Financial. It's all about income, legacy, growth. It's all right here at ILG Financial. Getting back to our conversation that we had earlier in an earlier podcast about IRAs, there are lots of things that people do that turn out to be mistakes and sometimes end up costing them thousands and thousands of dollars. Chase, and let's start today's conversation. We're going to talk about 10 more mistakes that people make. But let's start today's conversation with there are folks out there who think of an IRA as mad money. And, I don't know why exactly they call it that, but explain that if you would.
Yeah, absolutely. And to your original point, Ron, we're always here to save people money, right? So I think that's kind of a good segue into what we're talking about specifically with this topic. And mad money is a term that folks use to basically say, hey, this is going to be my bucket where I do, or my investment account, where I'm going to invest in things that are very speculative. So think specific stocks. You think this stock is going to go through the roof because you heard about it on CNBC last night, or, cryptocurrencies, right, is kind of a big one right now.
I'm going to take some chances here and maybe do a little gambling.
That's right. That's it. And, you read that article online and now you're like, oh, I know everything. This is going to work out all roses, right? But a lot of people think, well, my IRA, it's a long-term investment. I'll just do it inside of there. And then, eventually I'll make it up, or, that's kind of the rationale behind people using their IRA for this quote unquote mad money. But I encourage people not to kind of fall into that trap with being diversified, right? With using, funds and, a large swath of, very good companies that have been, vetted by funds or your financial advisor, is really the best way to build wealth over time. Not to say that you can't have some money, earmarked for, this mad money bucket that you have, but really your IRA, you should think of that as this is what's going to allow me to retire in the future, right? Mm-hmm. And if I frame it like that, then a lot of people will say, well, no, I would never gamble with that, right? I want to retire. I would never gamble with that. But sometimes, the marketing behind, some of these stocks and things of that nature can start to creep into people's head. But you really want to back up and think about the big picture here. Hey, do I want to be gambling with my retirement? And for most folks, they say no. So you want to get, a large diversified portfolio inside of there, and to make sure that, you can grow for the long term.
Well, as we have discussed many times before, there's a lot of strategy involved in financial planning, and certainly, some of us just don't know about all those things that you can do, and some people actually miss out on the chance to fill holes with an IRA. Maybe you're invested in certain asset classes or not invested in certain asset classes, and you want to make up for that, and so you may be able to use an IRA to satisfy your needs there, but how is it that folks can make a mistake like that, and how is it potentially something that may cost you money by not taking advantage of the opportunities?
Yeah, so this goes to something that we've talked about in a lot of different podcasts, both with myself and with Dave, which is whenever you're looking at one investment account, so your retirement plan at work or your IRA that you're contributing to on the side, you want to take a big step back and see, okay, what's the big picture here? How does my whole picture look with all of these different, accounts? And you want to make sure that all of them complement each other, right? If we're doing one thing in the retirement plan and we're doing something else that's completely contradictory over here in the IRA, well, then we're not making a lot of hay there. The analogy Dave likes to use is, let's say we have a boat and the boat's leaking on one end and we plug the hole on the other end, but then we have another hole on the other end of the boat. Well, then we're still at a deficit there, right?
Yeah, exactly.
We're still sinking. So that goes the same with when we're building out an investment strategy. You want to make sure that everything in your retirement plan is complementary of the things in the IRA. And the IRA has a little bit, has some more options as opposed to most company 401ks. So you can utilize that IRA to complement whatever you're doing in, your retirement plan. Because for a lot of folks, the retirement plan is, the bigger, larger account, and the IRA can kind of fill in those gaps for you.
So missing out on the chance to fill holes in your boat with an IRA.
That's right. That's exactly right.
Yeah. What about doubling up on tax shelters in an IRA? Take a moment and explain that, if you would.
Yeah, so this is actually a common one, and it's common because a lot of people just don't take the time to kind of dig in a little bit deeper as to what they're actually invested in inside of their IRA. So sometimes, as we've kind of alluded to up until this point, and we've alluded to in other podcasts as well, the traditional IRA, you get the tax deduction up front, it grows tax deferred over time, and then when you take the money out, that's when it's taxed, right? So it's a tax advantaged account. You get some tax advantages there.
Okay. Gosh, there's so many assets that you need to keep a close eye on, and you need to know about all these facets of the whole IRA philosophy. But Dave Lopez and Chase Lopez at ILG Financial can keep you abreast of all of that. 540-720-5656 is your number to call. 540-720-5656. Back to the conversation here on the Retire Your Way podcast. I'm talking about IRAs today, and there are folks who don't pay enough attention to asset location in an IRA. And Chase, tell us how you can help with that.
Yeah, so this kind of goes back to what we were talking about before, which is with every either a Roth IRA, a traditional IRA, or just a regular investment account, there's tax advantages to each of those different accounts. So we want to make sure that the investments that are inside of those accounts complement the tax advantages that they offer. So a great example is inside of your IRA or inside of your Roth IRA, you wouldn't necessarily want to have municipal bonds, right? Municipal bonds, the interest that's spit off is exempt from federal tax, but inside of a Roth IRA or a traditional IRA, you already have that tax advantage. So that would be an investment that we could possibly see in a regular account. So it kind of alleviates the taxes that you have in that regular account. Whereas inside of the Roth IRA or the traditional IRA, you can have some investments that either spit off interest income that you would otherwise have to pay taxes on, or that have good growth potential that you also, you may or may not would have to pay taxes on in the future. These accounts allow you to at least temporarily shield yourself from those taxes along the way. So it's really about having the right tool for the right account, doing the right job. And that's kind of where we step in for a lot of our clients, where we'll look at their entire investment plan and say, hey, there's some efficiencies that we can build in here just by not changing any investments, but by changing where the investments are being held, accounts they're being held in. And you'd be surprised, Ron, you could save thousands of dollars just by kind of creating those efficiencies based on the asset's location as opposed to what it's invested in.
That's what you do at ILG Financial. Take everything into account, and there's so much strategy involved in financial planning, and it's like putting together the pieces of a great big puzzle. So,
That's right. That's a great analogy. I like that. I'm going to steal that from you, by the way.
Well, no problem at all. You can get in touch with Chase Lopez and Dave Lopez and talk about all of that kind of stuff in much more detail. One thing that is supposed to be a very simple process is, and we've discussed it so many times, is rolling over a 401k to an IRA, and it's not supposed to be something that costs you money in taxes, but sometimes it is, and there are some folks who trigger a tax bill on an IRA rollover when they don't really mean to, but what can you do to help people avoid that?
So this actually can be a very costly mistake. I've seen people in the past who weren't working with us that came to us with a problem. But I've seen people in the past where they've lost, tens of thousands of dollars in taxes just by a simple, paperwork or accounting error. So this is a big one. You can move your IRA or your 401k, your traditional IRA or your traditional 401k, you can move them to different IRAs or 401ks. And so long as they stay inside of that traditional retirement account shell, then there's no tax, right? You can move it from one account to the other. And since you're moving it from one retirement account to the other, there's no taxes involved there. Where people get tripped up is they'll say, okay, I'm going to roll over my 401k to my IRA, and they don't have it sent directly to their IRA. They have it sent to themselves. And when you do that, you have 60 days to put that money into the IRA. Mm-hmm. Now, if you don't put it in within the 60 days, let's say, time gets away from you, as it does with all of us, right? Yeah. And you say, 6 months later, you're like, oh man, I forgot to put that money in my IRA. Let me try to do it now. Well, that entire amount is going to show up as taxable on your tax returns, and it's too late after that 60-day window closes to put that money into your IRA. So, for some people that could be, an additional anywhere between $100,000 to $500,000 of income that they report that year, which could push them into a higher tax bracket, which results in them paying more taxes. So you have to be very careful when you're doing that stuff to make sure that all your I's are dotted and all your T's are crossed.
Yeah, that can come as a real shock to someone who did that wrong, for sure.
That's an April surprise that no one wants.
Exactly, and another reason not to procrastinate.
That's it.
Putting things off is not a good thing. A lot of strategy, as I mentioned before, I think that word has come up about 5 or 6 times on today's podcast, but not being strategic about RMDs from a traditional IRA. Again, something that, you need to know all the ins and outs of this whole situation, and required minimum distributions, another thing that you need to fully understand.
Absolutely. And I'm glad you mentioned that, Ron, because as folks get closer to retirement and as they're saving for retirement, unfortunately, for a lot of people, this isn't something that was, and this is kind of a tangent of mine, so forgive me, but this isn't really taught in school, right? You're taught a lot about a lot of different things, but some of this stuff is never really covered. So people are really on their own out there when they're trying to piece together all of the information that they hear from various sources and things of that nature. So that strategy word that we keep coming back to is really a lot of people are working from a deficit there, and it's not their own fault, right? Just no one has kind of taught it to them. So that's why we do the podcast with you, right? This is why we do the YouTube channel. We send out our newsletters. And then ultimately, that's why we work with our clients, is to give them a better understanding of all this stuff, and to make sure that, they don't have, any money slipping through the cracks. But I digress. You asked about RMDs.
If you don't
right?
have a financial advisor, you're basically lost in the wilderness without a guide. That's
right.
one way I look at it,
Oh man, you're on fire with the analogies today. I think I'm going to take that one too.
You give me too much credit.
But in any event, right? I digress. We're talking about RMDs, right? So RMDs, required minimum distributions, is when you have to start taking money out of those traditional IRAs. So we got the tax deduction up front. You pay the taxes when the money comes out. Well, the government says, hey, we want our tax dollars, right? So they say you have to start taking money out of this account. You pay the taxes, and then you can do with it what you want at that point. But the money has to come out, and you have to pay the taxes on that. Now, when we're talking about required minimum distributions, some people might have multiple different IRAs. They may have 4 or 5 IRAs. So you want to be strategic based on how the market's performing, based on, the outlook for how, the market and the economy are looking. You want to be strategic as to how much you take out of each of those accounts to fulfill that required minimum distribution requirement. So you're not selling things at a loss, and you're not losing money by just taking, money randomly out of any account just based on, whatever you're basing it on. So you want to be strategic with, how you take those withdrawals, when you take those withdrawals. And that's what we help people with.
Yeah, a lot of people, when it comes to RMDs, they say, why do I have to take this money out? I don't really need it, so I don't want to take it out. But you really have to. And some people make a mistake by not reinvesting those unneeded funds, those unneeded required minimum distributions from an IRA. And take a moment to break that down, if you would.
Yeah, so to your point, some people say, oh man, I wish I didn't have to take this money out. They end up taking it out, and then they just stick it in their bank account, and it sits there for years, and it's earning, 0.1%, right?
Yeah.
And the reality is you don't have to do that. Now, the money that you take out of for required minimum distributions that you take out of the IRA, it can't go back into the IRA, or it can't go into, another tax advantaged account. But you can still invest it, right? You can open up a regular account and invest it, based on, your current strategy, right? So for example, if you had it invested in Apple stock inside of your IRA, well, you can take the money out, cash out the Apple stock in the IRA, take the money out, and then you can turn around and buy the Apple stock the next day in a regular account, and it's still going to be invested the way you want it invested. All the government cares about is they want the money to come out and they want the taxes, right? But that should not preclude you from reinvesting this money. And a lot of people just don't connect those two dots. They just stick it in their bank account, and then it's not working for them anymore. So definitely want to, work that into your plan when you're talking about RMDs and IRAs and things of that nature.
Again, the way to get in touch with Dave Lopez and Chase Lopez at ILG Financial is by calling 540-720-5656. You can have a conversation that's not going to cost you anything and not going to obligate you to do anything at all, but you will get a lot of good information there. And then we'll find all kinds of ways where the folks at ILG Financial can help you. When it comes to charitable distributions from an IRA, there are certain things that are qualified and not qualified, but not taking advantage of your opportunities in this regard. When it comes to charitable distributions, that can be a costly mistake as well.
Oh, absolutely. Absolutely. And again, this is one of those things, and we talked about this today, quite a bit. This is one of those things where a lot of people just aren't aware of this rule. So then they miss out just because it's the old phrase, you don't know what you don't know, right? So there's these rules out there that you can take advantage of that are built into the tax code. All you have to know, you just have to know them. So this is a great example of that. So let's say, you're charitably inclined and you donate money to a charity every year, every quarter, every month, whatever the case may be. Well, once you hit that required minimum distribution age that we were talking about before, where you're forced to take money out of your traditional IRAs, you can actually have that money sent directly to the charity of your choice. It's called a qualified charitable distribution. Mm-hmm. And if you do it that way, then that required minimum distribution will not show up on your tax return. You don't have to pay taxes on that withdrawal. So for folks that are already donating to charities, this is a great way to continue donating. And quite frankly, it allows you to donate a little bit more because this money is essentially coming out tax-free, as opposed to it coming out of your account, coming out of your IRA, going into your bank account. You paid the taxes, and then you send it to the charity. You could, send 20 to 30% more to the charity by just cutting out that middleman. And by middleman, I mean the government, right? As far as taxes go.
Uncle Sam. Yeah,
that's right.
There are lots of people who don't take advantage of that simply because they don't know, like you mentioned earlier. And that is something that is really a great option. I mean, it's good for you, and it's also good for the charity. So, you can do a lot of good by simply knowing about that one. Not paying enough attention to IRA beneficiary designations. This goes to the whole idea of making sure you have all your I's dotted and all your T's crossed, right?
That's exactly right. That's exactly right. So one of the things that we do for our clients is when we'll have an annual review. We'll basically review everything, look at how the last year went, look at how the next year will go. And part of that is us looking at folks' beneficiaries, right? So on your IRA or your Roth IRA or your even your 401k at work, you list a beneficiary. And all that means is if you were to pass, the money goes to this person, whoever that may be. Now, for some people, right, they set up this IRA or this 401k when they're 25 or 30 years old, and they never really changed the beneficiary. And your life may have changed. There may have been, new children in your life. There may be grandchildren that you want to make sure get taken care of, but they never end up updating those beneficiaries. And what a lot of people need to know is those beneficiaries that are listed on those accounts, that supersedes any sort of estate plan, any sort of trust, anything that you've put into place. The beneficiary completely supersedes that, even probate. These accounts aren't even subject to probate because of the beneficiary designation. So you want to make sure that whoever that beneficiary is the person you actually want that money to go to if something were to happen to you.
Yeah, you got to make sure that you end up leaving a lot of money to your ex-wife that you didn't want to leave anything at all to.
That's exactly right. Because here's the reality: is once that money goes to your ex-wife, nobody's getting that back, right? Yeah. She was listed as the beneficiary, and
she's not giving it back.
That's right. That's exactly right. That's exactly right.
All those things, override the will. So it's very important to pay attention to that. And one last thing I wanted to mention here about IRAs, mistakes people make. And this kind of goes to the bottom line here. This is why you should call Chase or Dave at ILG Financial. You can make serious mistakes without knowing it by not seeking advice on an inherited IRA. I mean, that's something that you need to make sure you do right.
Boy, that's so true, Ron. And the reason why this one's kind of a biggie is you may be, to your original point, unbeknownst to you, you may be setting your heirs up, whether that be your children or whoever. You may be setting them up for this big tax liability, this big tax burden that they otherwise had no idea was coming, right? Yeah. So you want to make sure that this goes back to the beneficiary conversation we had. You want to make sure that your children or whoever your heirs are getting with your financial professional so that they know exactly what to do if something were to happen to you. So the inherited IRA is a great example of that, where this needs when your children inherit your IRA or when you inherit your IRA from your parents, you have to be very careful as to what account that money goes into. You have to be very careful about taking money out of that account every year. You even have, as the inheritor, you even have required minimum distributions, and you want to make sure that you're doing everything you're supposed to, because the penalties and the taxes can be, I don't know a better word for it, but they can be appalling, right? A couple of years later, they do an audit on your taxes and you're like, holy cow, I owe all this money. So you want to make sure that all of everything you have is buttoned up. So I encourage everyone out there, if you have children that are listed as your beneficiaries and you're currently working with a financial advisor or a financial planner, introduce your financial planner to your children, right? They don't have to know how much money you have or anything like that, but if you have that simple introduction, now they'll know, hey, if something happens to mom and dad, at least I know I can reach out to, ILG, and they can help me with all of this stuff, so that, I'm not going at it alone.
Yeah, not only in this podcast, but in our previous podcast, we've talked about mistakes that people can make when it comes to IRAs, and there's a long list. I think we went through a total of 20 things. But if you want to take a deeper dive into all of that, have a conversation with Chase Lopez or Dave Lopez at ILG Financial. And before we go today, Chase, first of all, I just want to say it's been a pleasure talking with you as always, but are there any things that you would like to add before we go? Particularly about IRAs?
I don't think so. It was a pretty comprehensive list, I feel like we went over. I guess big picture, just make sure you're working with someone to make sure you got all of these different things taken care of. Make sure you're not messing anything up, because the reality is, and you alluded to it earlier, Ron, is Uncle Sam is unforgiving, right? Telling him that you didn't know what the rule was is not a good excuse. So you want to make sure you have everything kind of buttoned up and get with someone so you can make sure that it is.
Absolutely. Income, legacy, growth. It's all right here at ILG Financial, and it's about helping you plan for retirement your way so you can achieve all your financial goals and have the kind of lifestyle you've always wanted in your retirement. Call ILG Financial at 540-720-5656, or you can simply go online to ilgfinancial.com to learn a whole lot more. This has been the Retire Your Way podcast with Chase Lopez, ILG Financial. I'm Ron Stutz. Thank you so much for listening. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.